Okay, let's unpack this. Pinduoduo, launched in 2015, right? Which feels like, I don't know, a blink and you miss it moment in internet time.
Absolutely. Things move so fast.
And yet somehow they just blasted their way to a Nasdaq U IPO in what, 3 years?
3 years, yeah. Astonishingly quick.
And get this, it wasn't just like they entered the e-commerce space. They properly shook things up, overtaking Taobao in user numbers. That's huge.
It really is. It begs the question, how did a newcomer manage that kind of disruption in a market that looked, well, pretty sewn up?
Exactly. So that's what we're doing in this deep dive. We're digging into the sources we've got to really get under the hood of Pinduoduo's incredible rise.
And not just the rise, but the challenges they're facing now, too, right? And maybe peek into the future a bit.
Precisely. We'll look at the business model, the financials, some interesting strategic shifts happening internally. The mission, as always, is to get you up to speed, give you the core insights without, drowning you in data.
Right. We want to pull out the key knowledge, connect the dots for you, give you a clear picture, and maybe some interesting things to think about.
Okay, so the Pinduoduo phenomenon, where did it all start? What was that initial spark? The magic, maybe?
Well, the foundation really was their social e-commerce model. You remember those chop-up-price things and group buying?
Oh, yeah, on WeChat mostly, wasn't it?
Exactly. They leveraged WeChat's huge network.
Right?
But it wasn't just discounts. It tapped into, like, social interaction. It was almost a game getting friends involved to lower the price.
Ah, okay. So it created this kind of network effect. Users brought in other users.
Precisely. It was a very, very low-cost way to acquire customers compared to traditional advertising. Really powerful dynamic.
Like a digital word of mouth, but supercharged. And then there was the price strategy, the extreme low price thing.
That was crucial. They went straight for what they call the sinking market.
Meaningful.
Basically, price-sensitive consumers, often in lower-tier cities.
Yeah.
People maybe underserved by the bigger players like Taobao and JD.com back then.
And they just undercut them.
Consistently. They understood that for this huge group, value for money was absolutely paramount. Pinduoduo gave them access to goods at much lower prices.
How did they manage that? Was it just volume?
Volume helped through the group buys, but also direct sourcing. And crucially, their light asset operation.
Ah, right. So they weren't bogged down with like massive warehouses and logistics networks themselves.
Exactly. They focused on being the platform, connecting buyers and sellers, and making money from traffic ads and commission. This let them keep costs down and achieve this, well, really high gross profit margin.
Around 60%.
60%, wow. That's considerably higher than competitors, isn't it?
Oh, yeah. Big difference. It funded a lot of their growth.
Okay, so that explains the initial explosion, but how did they keep that momentum going? Did the strategy change?
It evolved, definitely. That user growth engine adapted. The WeChat social spread was key at first, but later they brought in users from bigger, higher-tier cities, too.
Was it still the low prices? Partly, but they also used those massive 100 billion subsidy campaigns. You probably remember those. Big discounts on branded goods.
I do, yeah. That felt like a shift.
It was. They called it consumption upgrading, moving beyond just the absolute cheapest stuff, trying to attract a broader audience.
Interesting. So broadening their appeal. Now, what about the supply side? Keeping those prices low must have involved some efficiency there, too.
Oh, absolutely. Supply chain efficiency was vital. They built direct links with lots of small and medium manufacturers, even agricultural producers.
Cutting out the middleman.
Essentially, yes, fewer layers means lower markups. Plus, their algorithms were pretty sophisticated, matching demand with supply very efficiently.
Like a super fast digital matchmaker between the factory or farm and the shopper, okay? And we can't forget Temu, their international push.
Right. Launched in 2022, took that low-price model global, particularly targeting Europe and the U.S.
Using that small package duty-free loophole, or rather provision.
Exactly. The low price plus small package duty-free strategy was key to getting traction quickly. But that's also a potential vulnerability now.
Because the U.S. might change that policy, the under $800 threshold.
Precisely. If that goes away, it could seriously impact Temu's cost advantage and, well, its whole model in the U.S. market.
Right. Definitely one to watch. Okay, let's pivot to the financials. The numbers look, well, pretty staggering on the surface.
They really are. Revenue growth, you mentioned 2020 was 59.4 billion yuan. By 2024, it hit 393.8 billion.
That's, what, a 50% compound annual growth rate? More than that, even?
Over 50% CAGR, yes. It's incredibly impressive. And they're profitable, too. 2024 net profit was 112.4 billion yuan. That's a net margin of 28%.
And how does that compare?
Significantly better than Alibaba and JD.com on the margin front.
Remarkable figures. But our sources also flag some potential risk points. It can't all be smooth sailing, can it?
No, definitely not. One major flag is slowing growth. That incredible revenue growth is expected to dip below 50% after 2024.
Okay, so maybe hitting a ceiling, market saturation.
That's the concern, yeah. Are they running out of room for that kind of hypergrowth domestically? And another point is their R&D spending.
Low, is it?
Relatively, yeah, around 3.2%, which, combined with their history of relying heavily on traffic driving strategies, raises questions about their technological moat.
Meaning, do they have deep, unique tech advantages that are hard to copy?
Exactly. Have they invested enough in things like, say, really advanced AI for recommendations, logistics optimization tech, platform security, compared to competitors who might spend more in those areas? It could be a long-term vulnerability.
I see. So maybe more focused on acquisition than long-term defensible tech.
That's the potential interpretation, yes. And this all happens as competition heats up.
Right. Domestically, doing e-commerce is a big new force, isn't it? And the old guard, JD, Alibaba, they're fighting back.
They are, particularly in that sinking market Pinduoduo initially captured. They're not conceding that ground. We saw that statistic.
The merchant switching.
Yeah, around 1.1 million Pinduoduo merchants reportedly moving to Taobao between Q3 2023 and Q1 2024. That's not insignificant.
Definitely shows the pressure is on. And internationally for Temu, besides the tariff risk.
Stiff competition. You've got Amazon, the established giant, and then Shein, which is another fast fashion powerhouse also built on a low-cost model. It's not an easy market to crack, even with low prices.
And then there are the, let's call them brand image issues, compliance stuff.
Concerns around counterfeit goods have plagued them, leading to regulatory attention and fines. Data privacy questions have also surfaced.
How damaging is that long term? Does it erode trust?
It absolutely can. Trust is, fundamental in e-commerce. If users worry about getting fakes or how their data is used, they might just go elsewhere, to platforms they perceive as safer and more reliable.
Which brings us to this really fascinating part, Pinduoduo's recent, almost weird shift in communication.
Yeah, this really stood out. After all that crazy growth, 86% revenue growth, 144% net profit growth in one period, mentioned they suddenly started, as one source put it, actively and repeatedly talking down its own prospects.
Which tanked their stock price for a bit, right? Why on earth would they do that? Seems counterintuitive. Is it managing expectations? Dodging regulators?
Well, their stated reasons are all about a pivot towards high-quality development. That's the phrase they're using.
Okay. What does that mean in practice?
They're saying they're going to invest heavily, tens of billions of resources in things like platform trust, security, supporting better merchants, improving the whole ecosystem for sellers.
And they waived fees too, didn't they?
10 billion yuan in transaction fees for merchants. Yeah, that sounds like a concrete step. It's a real shift from the old focus on just rock bottom prices and maybe squeezing merchants hard.
A very sharp turn. What do you think is really driving it beyond the official statements?
It's likely a mix of things. Some reports suggest the founder, Huang Zhang, prefers a lower profile. But also, the downsides of that hypergrowth model were probably becoming undeniable.
Like what?
Squeezed margins for manufacturers may be leading to quality corners being cut, policies like unconditional refunds causing headaches for sellers, and maybe even impacting quality overall. Negative externalities, basically.
So the model that got them there wasn't sustainable, or maybe it was creating too many problems.
That seems plausible. And you have to look at the competition, too.
How so?
Well, Taobao, Douyin, others, they seem to be shifting away from just pure price wars. Taobao apparently switched its search ranking back towards GMV, not just lowest price. They even eased up on unconditional refunds.
Interesting. And Douyin?
Douyin also seems to be signaling that lowest price isn't their absolute top priority anymore. So if competitors are changing tune, maybe Pinduoduo merchants who felt squeezed now have other options.
That makes sense. A changing battlefield. So Pinduoduo might have looked internally and thought, okay, this relentless price war isn't the only game anymore, or maybe it's hitting diminishing returns.
Could be. Maybe internal numbers like annual order frequency per user weren't hitting those super high gross targets anymore. And we did see them starting to push higher price, branded, higher margin stuff more.
Right. And their chairman, Chen Lei, mentioned consumers wanting more diversified things, like experiential and rational consumption.
Exactly. It suggests an internal realization that consumers aren't just chasing the absolute bottom price. Quality, brand, experience, they matter too.
And then there's the potential government angle.
Possibly. The official emphasis on strengthening industry self-discipline and preventing vicious competition, you could read that as a hint towards the kind of aggressive tactics Pinduoduo used to grow so fast. Maybe a signal to cool it down a bit.
A nudge from regulators can definitely change corporate behavior, and they did take concrete steps, didn't they, after this talk of high-quality development?
Yes. They introduced refunds for technical service fees on cancellations, and they cut the basic rate from 1% down to 0.6%. Tangible benefits for merchants.
And they started talking about supporting specific merchant communities, like flower growers or nail sticker makers.
Highlighting support for reputable merchants in specific industries, like Bozu for teas or Donghai for nail stickers. It actually sounds a bit like Taobao's old Taobao Villages strategy, trying to nurture specific ecosystems.
So really doubling down on improving the merchant environment and, as they said, platform trust and security seems like a genuine strategic shift.
All the signs point that way, yes. It's a significant pivot.
Okay, so wrapping this up, looking ahead, what's the outlook based on all this?
Well, short term, a lot hinges on Temu. Can it navigate those potential tariff changes in the U.S. and elsewhere? And can Pinduoduo maintain those high domestic profit margins while investing in this quality development and facing tougher competition?
Tricky balancing act. And longer term.
Longer term, there's always speculation about consolidation. Could we see a mega merger, maybe involving JD.com and Tencent's assets, creating an even bigger competitor? But fundamentally, for Pinduoduo itself, the big question is whether they can truly shift from growth driven purely by traffic.
To growth driven by efficiency and experience.
Exactly.
Yeah.
Which probably requires more sustained investment in that underlying technology, that moat we talked about.
Okay, so let's try and summarize the key takeaways here. Pinduoduo's rise was, well, meteoric, built on disruptive social commerce and aggressive low pricing. Fantastic financial growth followed.
But now they're facing real headwinds, tougher competition, international risks, maybe the limits of their old model.
Which has led to this major strategic shift we're seeing now, a pivot towards quality, sustainability, trying to build better relationships with merchants, focusing on trust.
It's a fascinating turn, which leads us to a final thought for you, our listener, to chew on.
Given this apparent pivot by Pinduoduo, this move away from just relentless price cutting, does this signal a bigger change in the whole Chinese e-commerce scene?
Are we moving past the era of pure price wars towards something more balanced? An ecosystem where quality, experience, maybe even merchant sustainability start to matter more across the board.
And what would that mean for you as a consumer? Or for the other big players like Alibaba, JD, Douyin, how might they react?
Yeah, it's definitely something to watch. Is this Pinduoduo finding religion, so to speak, or is it the start of a whole new chapter for Chinese e-commerce? Interesting times ahead. We genuinely love to hear your thoughts on this. Jump into the comments section and let us know what resonated. Which type of wealth are you focusing on?
Yeah, let us know.
And hey, if you found this discussion useful, maybe learned something new, definitely hit that subscribe button. We do these deep dives regularly, exploring valuable ideas.
We appreciate you tuning in.
Yeah, thanks for joining us.